Common Stocks and Uncommon Profits by Philip Fisher. Today, we'll discuss some truly timeless investing insights revealed in Philip Fisher's 1958 book, Common Stocks and Uncommon Profits. But before we dive in, if you find insights like this valuable, hit that like button and kindly subscribe. Your support means a lot to us. Now, while Fisher explores several factors that can guide smart investment decisions, we want to focus on what we see as his 15 key takeaways most applicable to investors today. The book offers broader perspectives on evaluating corporations, company leadership, industry trends, and more. But these key points have deeply informed our approach to markets as individual traders and advisors to larger funds. Specifically, Fisher advocates patience, diligence, and focus on company fundamentals over reacting to market volatility or hype cycles. His wisdom helps investors discern between long-term intrinsic value and short-term speculative bets. This video categorizes Fisher's wisdom into 15 brief takeaways, thought-provoking questions around attractive growth indicators, profit durability, operational effectiveness, quality management, and integrity. Let's dive into each area now. Takeaway 1. Is there substantial potential for sales growth in the company over the next few years? Fisher suggests that one should evaluate to both the growth potential and the probability of its actualization. Management competence, industry trends, and business cycles should be considered. Likewise, Fisher encourages emphasizing the quality of growth by examining trends over multiple years rather than relying solely on year-to-year comparisons. Takeaway 2. Is the management committed to advancing product and process development to boost overall sales once the growth potential has been maximized? Unlike the first aspect, which Fisher views as a factual consideration, this second aspect hinges on the attitude of management. It requires managers to discern when existing opportunities have peaked and when it is necessary to venture into new developments. Moreover, Fisher emphasizes establishing a business connection between new engineering, research, and current operations. Notably, companies are more likely to thrive in new industries linked to their existing business rather than entirely unrelated ones. Takeaway 3. Is the company oriented towards long-term profitability? Certain businesses, for instance, may sacrifice short-term gains to prioritize the well-being of customers, partners, or suppliers during unconventional or challenging situations, aiming to enhance relationships and long-term profits. Fisher and numerous other value investors assert that companies demonstrating a sincere commitment to long-term profitability are more inclined to achieve enduring success. This perspective aligns with Warren Buffett's investment philosophy. Takeaway 4. Will the company's future growth need fresh equity financing, potentially offsetting benefits for current shareholders due to dilution? This point underscores the company's reinvestment needs for growth. Fisher emphasizes the importance of a company relying on existing cash and careful borrowing for future growth. If not, the attractiveness of the investment depends on the expected dilution for existing shareholders that comes with subsequent equity financing. Therefore, the expected earnings growth must be substantial enough to justify the cost of dilution. Takeaway 5. Is the company's profit margin appealing? According to Fisher, optimal long-term investments are unlikely to involve companies with slim profit margins. Investors are advised to seek consistently healthy margins over several years, ideally surpassing those of competitors in the industry. Fisher acknowledges an exception for fledgling companies sacrificing profits to expedite growth in the coming years. In such cases, it's crucial that the increased spending is directed towards endeavors like research, sales promotion, or other activities that enhance the company's prospects, distinguishing it from a company compelled to reinvest all profits merely to stay operational. Takeaway 6. What measures is the company implementing to safeguard or enhance its profit margins? Fisher favors companies that consistently assesses their operations for enhancements and avenues for growth. He cautions readers to be vigilant of industries where profit margins increase solely due to straightforward price hikes, as this might not be an appealing signal for long-term investors. Before we dive into our next set of financial insights, take a moment to show your support for financial wisdom. If you find value in what we're sharing, give that like button a high five and hit the subscribe to stay in the loop with our future wealth building adventures. Trust me, your financial future will thank you. Now back to the money magic. Takeaway 7. Are there distinctive attributes within the business or industry that offer valuable insights into the company's standing compared to its rivals? This is a comprehensive question for investors to remember, since company circumstances are likely to vary case by case. Illustrations may encompass expertise in manufacturing, excellence in sales and service, customer loyalty, or possession of patents. Professor Bruce Greenwald has recommended that investors consider demand advantages such as customer loyalty, supply advantages like technological advancements, and economies of scale that could give a business an edge over its competitors. Takeaway 8. Is the company's research and development effort efficient considering its size? Fisher emphasizes that successful outcomes in R&D require investment, expertise, and effective coordination among individuals with diverse skills. Integrating research, production, sales, and top management is crucial. Fisher discourages inefficient R&D practices, such as frequent personal shifts, as they may raise the cost-to-benefit ratio. He suggests a more comprehensive understanding of the impact of R&D on sales and net profits to assess its value accurately. Takeaway 9. Does the company possess an exceptionally effective sales team? The viability of a company depends on its ability to generate sales. Fisher asserts that investors often overlook the relative effectiveness of a company's sales, advertising, and distribution organization. Nevertheless, he emphasizes that the foundation of a company's success lies in exceptional research, production, and sales efforts. Takeaway 10. Does the company exhibit strong cost analysis and accounting controls? Companies must possess accurate and detailed insights into their cost and revenue drivers to formulate and prioritize effective strategies. Without such clarity, management may inadvertently address issues that may not necessarily require the utmost attention. Takeaway 11. Does the company have outstanding labor and personnel relations? Fisher underscores the significant impact of good personnel relations on a company's profitability, surpassing the potential costs of workforce strikes. Effective leadership and favorable working conditions enhance worker productivity, minimizing expenses associated with training and turnover. Fisher proposes assessing workforce turnover rates and job application waiting lists compared to competitors as indicators of labor quality and personnel policies. Takeaway 12. Does the company have exceptional executive relations? Fisher argues that a company's success relies heavily on discernment, creativity, and collaborative spirit among its executive personnel, and executives must have trust in their heads. Also, promotions should be merit-based rather than driven by factionalism. Salaries should align at least with industry and local averages, and adjustments should be evaluated for merit increases. External hires should only be considered if there is no suitable internal candidate for promotion or to fill the required role. Takeaway 13. Does the company demonstrate managerial depth? Fisher emphasizes that even smaller companies should have a contingency plan if key leaders and talent become unavailable. Companies with promising investment prospects must evolve and expand over time. Executives in such companies often need to cultivate depth in skills and experience to seize growth opportunities. Fisher points out that companies failing to delegate authority adequately will hinder the development of future executive talent, as middle management staff will miss opportunities to grow. Additionally, insufficient delegation results in an overload of details at the top, hindering effective handling. Competent managers should welcome and assess suggestions and ideas from across the organization, even if they involve critique. Takeaway 14. Is the management forthright with shareholders during favorable and unfavorable situations? Setbacks are inherent in both thriving and struggling businesses. Management that fails to communicate openly during challenging times may signify a lack of solutions to problems and a lack of responsibility to shareholders. Fisher considers it a warning sign when managers are not candid in positive and negative circumstances. Takeaway 15. Does the company have a management team of unquestionable integrity? Fisher suggests that investors should limit their investments to companies where the management demonstrates a strong commitment to stewardship and moral responsibility toward shareholders. Poor management can exploit various avenues to gain advantages at the expense of shareholders. One prevalent method is the misuse of stock options by executives. Other indicators include hiring relatives with irrelevant expertise at salaries exceeding fair value, leasing or selling personal assets to the company at rates above the market norm, and choosing vendors or suppliers for personal connections or cross-holdings. Points 14 and 15 align with Warren Buffett, who preferred investing in rational, intelligent, and honest managers with robust integrity. In summary, Philip Fisher's investment principles guide today's investors. From assessing sales growth to scrutinizing management integrity, Fisher's wisdom forms a robust foundation. If you found these insights valuable, give us a thumbs up and consider subscribing for more content like this. Your support keeps us motivated. Thanks for joining us on this journey through timeless investment advice. Happy investing.